What are charts? What is the significance of charts? How do I look up my favorite stock on a chart? Today, we will answer this and more. Hello everyone. Stockshala is pleased to welcome you to its second episode on technical analysis. Today, it's all about the charts. In the age of Uber and Olas, maps are a great visual tool. Maps provide accurate visual information about your current location and the best route possible to reach your destination based on all the information available. Maps are a very important tool for the taxi industry. Every job demands the right tool for the job. Trading is no exception. Trading is simply implementing the philosophy of buy low and sell high. Charts provide us a means to achieve this. Price and volume chart is the primary tool for technical analysis. A stock's historical price and volume are plotted on a chart to provide a beautiful visual image of market behavior over time. Investors can then use charts to study and understand the health of a stock or a market and make trading decisions. Fortunes are made every year by those who take the time to learn and interpret charts properly. But remember, you must take the time to learn before you can earn. Charts serve as an important timing tool by helping you to determine entry and exit points on your trade. It's not just that, they also serve as a risk management tool. How so? Well, using charts, you can identify your stop loss point and exit trade whenever trade goes against your prediction. All of this makes it clear that chart is the primary tool for technical analysis. There are a number of types of charts out there. However, today we will focus on three of the most commonly used types of charts: the bar chart, the line chart, and candlestick chart. What is a bar chart? In a bar chart, each day is represented by a bar or a vertical line that ranges from the day's low to the day's high. The day's open price, which is the price at which the first trade of the day happened, is indicated by a horizontal protrusion to the left of the bar, whereas the day's close price, which is the price at which the last trade of the day happened, is indicated by a horizontal protrusion to the right of the bar. In a weekly chart, this would mean that each bar represents the price movement for the week. The bar or the vertical line itself represents the range of low to high of the week. The horizontal protrusion to the left would indicate the open price of the week that happened on a Monday morning. Horizontal protrusion to the right indicates the close price of the stock on Friday evening. The next type of chart we're going to understand is a line chart or a close-only chart. Line charts are plotted using close price of a stock alone. So pick up all the close prices of the stocks and connect them together to form a line chart. All the other elements of price, such as open, high, and low, are completely ignored. Some traders prefer line charts because they believe a lot of noise is eliminated by ignoring other price elements and simply focusing on the close price. The chart looks much simpler than others visually. The last type of chart that we're going to look up today is candlestick chart. Candlestick charts are by far the most commonly used type of chart. The middle white portion of the candle is called the body or the real body of the candle. The lines above and below the body are called wicks or shadows of the candle. The body of the candle represents the range between the open price and the close price of the day. The shadow above the body represents the day's high, whereas the shadow below the body represents the day's low. Candles are color-coded based on price movement. If the stock closes at a price higher than its open price, then a green candle is formed. On the other hand, If the close price is lower than the open price, then a red candle is formed. If the open and close price are equal, a candle without a body is formed. We will talk in depth about candlestick charts in our future episodes, but for now, this should do. Now that we've seen 3 of the most commonly used types of charts, let's dive into a real-life chart. For that, I'm going to take you into investing.com website. Now this is a free website. You could use this to look up your favorite stocks. So I'm going to look up my favorite stock today, and that is TCS. There we go. Yeah, so as soon as you go into TCS, you see it opens a little chart window here. I'm going to click on technical chart and then click on this maximize button so we can see chart in a nice big screen. Now, so this is the name of your stock here, and then you have this time pane where you could choose the time interval of your chart from 1 minute all the way up until 1 month. The lower time frames up until 1 hour are usually preferred by day traders, where they enter and exit on the same day. The longer ones from 1 day to 1 month are usually preferred by swing or positional traders, where the trade lasts several days, weeks, or sometimes even months. So I'm on the daily chart for TCS. The pane here lets you to choose the type of chart you want. So the first type of chart we learned today is the bar chart. So I'm going to click on bars, and now we have daily bar chart for TCS. So if you look at a bar, each of this bar represents the price movement for the day, ranging from the day's low to the day's high, horizontal protrusion to the left indicating the day's open price, and horizontal protrusion to the right indicating the day's close price. Now let's play around a bit with the time interval. So there's a very interesting property when I do that. So if I move from the daily chart to the weekly, you can see the chart gets much more smoother and nicer, and it provides you sort of a zoom out effect. And if I zoom out from the weekly to the monthly, you can see it's much more smoother, much more stable and nicer. So if you go down on the smaller time intervals, it provides you the zoom in effect. So from the monthly, I could zoom in into weekly chart and see what happened during the weeks. From weekly, I could zoom in into the daily chart and see what happened during the days, and so on. So the time intervals provide this nice zoom in and zoom out effect. It's not just that. The smaller time intervals tend to be noisy generally, whereas the longer time intervals are smoother and stable. Now that we've seen bar chart, let's move on to line chart. Line chart, as we already understood, is very simple. It has simply connected the closing price of the stock and formed this nice line. And you could see the effect of zoom in and zoom out and the smoothness on the line chart much better. So if I go into weekly chart, you see it's much more smoother. On the monthly, it's all the more smoother. The last type of chart we learned today are the candlestick charts. So now I'm on the candlestick chart for TCS. So each candle here, as we understood, represents the day's price movement, the body of the candle representing the range from the day's open price to the day's close price. The wick above represents the day's high, and the wick below represents the day's low. So this is really how you can go onto investing.com and look up your favorite stock. I'd highly recommend you to go and look up your favorite stocks, play with different types of charts, and have fun with it. Now that we've seen the different types of charts, we've understood that chart is the primary tool for technical analysis. We've learned about 3 of the most commonly used charts: bar chart, line chart, and candlestick chart. We've also understood some important properties about charts. The longer the time frame, the more smoother the chart, the more stable and reliable the signals are. Thank you very much for listening. If you liked this episode, please click on the like and subscribe button. If you have any feedback or questions, put them down in the comments section. I'd be more than happy to answer them. See you in the next episode.